This week's investment update: market volatility enters its second week, Brexit hangs in the balance, a crucial US earnings season gets underway, while a steady stream of data shines a spotlight on the UK economy. For investors who have enjoyed one of the longest bull markets in post-war history, if not the longest, the past week has been an uncomfortable reminder that the price for the long-term outperformance of shares is periodic volatility. As is often the case, the areas of the market which have risen most strongly have borne the brunt of the correction, and technology shares, which have driven the market higher over the past 3 years, have fallen sharply. The S&P Tech Index slid almost 7% last week, as the so-called FANG stocks such as Facebook, Apple, Amazon, Netflix and Google owner Alphabet were hit hard. The theme was confirmed by a plunge of 6% in just one day on Thursday for the tech-heavy Taiwanese stock market. The country's a big supplier to US tech companies and is dominated by the production of key components like semiconductors. This week, the selling continued in Asia on Monday morning despite Wall Street's stabilisation on Friday, leaving investors unsure whether to view the past few days as a pause that refreshes the market or the start of something worse. Investors looking to explain the sudden bout of risk aversion focused on rising interest rates in the US, although this is hardly a new story. What is becoming clear, however, is that the Federal Reserve is determined to return US interest rates to something close to pre-crisis normality, now that the American economy is undeniably on a growth tack once more. Bond yields, which are driven by interest rate and inflation expectations, have risen to multi-year highs, as investors bet on the Fed continuing to tighten policy throughout 2019 in response to unemployment at historic low levels and the threat that this would in due course feed through into rising prices. The 10-year US Treasury bond, the key benchmark, hit just over 3.25%, a 7-year high, before easing back at the end of the week. Rising bond yields are typically bad news for share prices because they mean that for income-seeking investors, the stock market is no longer the only game in town. Bonds and cash can offer a less volatile and less risky alternative to shares, and that can put pressure on highly valued stock markets. Rising bond yields are also bad news for shares because they increase the cost of borrowing for companies, and they reduce individuals' personal spending power as the cost of funding a mortgage, for example, increases. Rising bond yields are the main reason for falling share prices, but they're not the only one. Other likely culprits include worries about the global growth outlook in the face of rising trade tensions and high valuations, with these fundamental challenges exacerbated by automated trading strategies which sell shares as prices fall. That builds on existing swings in the market and increases volatility. This final element can see momentum in both directions increase rapidly, and it's a key reason why investors should not overreact to short-term price movements, which can and often do quickly change direction again. Studies show that the biggest rises in markets often occur soon after the biggest falls, and nervous investors can find themselves out of the market at just the wrong time if they fail to hold their nerve through market volatility. This can be very costly. Missing out on just a handful of the best days in the market can result in a dramatic reduction in long-term returns. Now, none of this should play down the scale of the recent retrenchment. US stocks have now endured their longest losing streak since Donald Trump became president. The fall of nearly 7% in just 6 days rivals the market correction in February and confirms that markets have entered a more volatile period, and that's typical of the later stages of the market cycle. As ever, markets are probably overreacting. At the beginning of 2016, most investors were pessimistic, and the market duly performed well as low expectations were exceeded. By the beginning of this year, though, many investors were more optimistic, and perhaps unsurprisingly, markets have done less well since then as a series of factors have combined to undermine the bullish narrative. In particular, Donald Trump's combative stance on trade with China has called into question the sustainability of global growth, as America First nationalism threatens to put the last 30 years' globalization into reverse. emerging markets have been particularly hit by these fears, and China's stock market has now given up all the strong growth of 2017 so far in 2018. For investors, what matters is earnings growth, and so far, thanks to President Trump's tax cuts, this has been enough to keep the US stock market on the boil despite rising trade tensions. How long that continues will become clearer over the next few weeks as the third quarter earnings season, covering the July to September reporting period, unfolds. The season got off to a solid start with JP Morgan, Citigroup and Wells Fargo all reporting big increases in profits last week. And this week, more than 50 of the S&P 500 constituents are slated to report numbers, including Johnson & Johnson, Morgan Stanley, Goldman Sachs and American Express. With profits due to rise at more than 20% year-on-year on average for a third quarter on the trot, fueled largely by those tax cuts, there is a reasonable concern that such a rate of growth is unsustainable. Certainly, in today's more febrile environment, any companies which disappoint investors are likely to be punished in the market. On this side of the Atlantic, the big story, despite the FTSE 100's fall below 7,000, is actually not the market. Rather, it's the continuing Brexit saga, which appears to have reached a dramatic standoff just days before a key summit this week, at which the British government was hopeful of agreeing a draft treaty to take Britain out of the EU and to set up a further meeting in November to seal the deal ahead of next March's withdrawal. No one is surprised that negotiations are going to the wire, they always do, but the return to Britain of Brexit Secretary Dominic Raab after a bruising meeting with chief EU negotiator Michel Barnier raised the prospect of a complete breakdown in the talks and a no-deal exit for Britain next spring. Theresa May, Prime Minister, is playing for time, but it's becoming clear that there are no easy or even difficult solutions to the contradictions inherent in Britain's desire to leave the EU while maintaining the integrity of the United Kingdom. Agreeing a deal that's acceptable to the other 27 members of the EU and the Conservative Party's Eurosceptic wing is proving as impossible as the sceptics feared it would. Unsurprisingly, the pound is in modest retreat this week, falling back towards $1.30 as the possibility of a collapse in the government, a snap election and perhaps the election of a Jeremy Corbyn-led Labour government looms larger. Meanwhile, the impact of all the Brexit uncertainty will become a little clearer this week as a steady flow of UK data shines a light on the British economy. This week's numbers include labour market figures, which are expected to show an unchanged unemployment rate of 4% in August, inflation data with consumer prices estimated to have climbed 0.2% in September for a 2.6% year-on-year rise, and retail sales data, which should unveil a slide month-on-month in September, but a 3.7% gain for the annual comparison. Now, a key driver of the inflation data is the oil price, which is firmly in focus as the market watches developments in both Iran and Saudi Arabia. Iran is due to feel the full force of US sanctions next month, which by itself would likely have seen the price of crude rise. But added to this is a growing international row over the disappearance of Washington Post journalist Jamal Khashoggi and the kingdom's threat to use its economic power to retaliate if it is also targeted by sanctions. So having bounced around between $70 and $80 a barrel, the price of Brent crude has been as high as $86 in recent days, as investors have started to question whether $80 might be a new base for the oil price rather than the ceiling it's been for some time.